So I am Lisa Doyle, and my partners are on the line. We'll introduce everyone. Welcome to our weekly Comms and Coffee. And so we always want to be bringing to everyone, all of our clients, just people we know, information that you guys are wondering about, whether it's real estate related questions, whether it's market related questions. So this week, we brought two experts to share some information that we know everyone has at the top of their mind. So our plan was a post-election tax strategy, investment strategy. We know that there's still some questions about how everything will unfold. We thought we'd have an answer today by who's our new president, or who will be the next president for the next 4 years. But we're going to answer questions as if we on either side. And we want you all to know that we understand we don't have a crystal ball, so we're going to answer from the expert's perspective. So we have some great guests joining us. So Stephen Palmer, he is a CPA with RCP. And thank you so much, Stephen, for joining us. We appreciate it. And then we have my good friend, Martin Johnson. He is with Sagemark 365. And Martin Johnson's a wealth manager. He is here to give us all their wealth advice. How do we react and what do we do? Thanks so much, Martin, for joining us. I so appreciate it.
Thank you, Lisa.
Yeah, we appreciate it. And then, of course, we have all of us. So my team's on the line or on today. We've got Ryan Day. He's a realtor.
How you doing?
My partner and sister, Kim Winters, on the line. Felicia Lopez, my daughter partner. TJ Smith, awesome realtor. And Diana Carcamo, also realtor. And then we have our partner, Andrea Markoulis, although we have a little bit of a video issue, but she's with us as well. She's our partner. So Martin, we've got a bunch of questions that we've had clients ask, Martin and Steve. But why don't you guys introduce yourselves just a little bit about your background, how long you've been in your industry, and then we'll fire away some information and questions. So Stephen,
Great. Who wants to go first? Yeah, go ahead, Steve.
Go ahead, Steve.
All right, my name is Steve Palmer. I'm a partner at RGP LLP accounting firm. We have a location in Pleasant Hill. We have about 15 people there, and I've been working with the same group of people since 2006. I graduated from Utah Valley State College. And I reside in Martinez. And, enjoy real estate. That's, I think, how I got looped into all this. I am a real estate investor myself. So we have lots of clients with real estate, both commercial and residential. So that's how I got connected with all these groups. But yes, very much enjoyed saving people money with taxes and investing in real estate.
Yeah, wonderful. Yeah, you've always been a great resource for us, so we so appreciate your expertise. And then Martin, so tell them a little bit about your background and what you do.
Oh, sure. Thank you. Thanks again, Lisa, for inviting me. I really appreciate the opportunity to chat with everybody. My name is Martin Johnson. My firm is Sagemark Consulting. I'm in San Ramon. You can find me at sagemark365.com is my website. I do comprehensive wealth management and financial planning, focusing on investment planning, estate planning analysis, retirement planning. I also do a lot in the insurance area of life insurance, annuities, long-term care, disability insurance, and have helped a lot of people over the years. I've been in the industry about 21 years.
Yeah.
So again, thanks for the opportunity to join you here today, Lisa.
Oh, no, we so appreciate both of you joining us because we've been planning this for about a month or longer, and we all believed that we would know what the administration was going to look like for sure next year and the coming years. But we're going to go ahead and answer questions based on, kind of both sides, just depending on what ends up unfolding after all this is over, worked through. And we also wanted to share with everyone that the advice that we're going to give, we do not have a crystal ball. We're going to give you advice based on what we believe to be true. We've got experts here to share. But again, there's everything a little bit under the possibilities. So again, we'll give more clarity again next year. Maybe we'll reconvene after everything unfolds next year and a little bit more light.
There are some unanswered questions with the Senate still not decided.
That's right.
Regarding a lot of these things that could change.
For sure. Yeah. So there's still some unanswered questions. So why don't we do this? We have some great questions from clients of ours that have reached out, people that are in communities that we specialize, that we work, and families that we've helped for years. So Kim, why don't you ask the question from one of your clients? I know that was a good one.
Yeah, so Mike in Walnut Creek has asked, so this is a question I think for Stephen, how is it likely the estate tax would change under the Biden administration?
So again, reiterating, this is all projected and just what
Right.
names that have released. But overall, what we're seeing is that right now, under the Trump administration, that the estate level is about $11.5 million per person. So that's $23 million for a couple can be excluded from estate taxes. Under the Biden plan, as it's released by his campaign, it would reduce it to $3.5 million per person. So that's a huge reduction. The other thing that would happen is that you would lose the step up in basis. So not only would you pay estate taxes on anything over 3.5, you would also pay the increase of any value of the assets you inherited. You'd pay capital gains on all of the gain that you've had. Now, this brings up even an interesting thing, because when you talk about gains, you have to know what the asset was purchased for. And if you can't prove it, the IRS considers that basis to be zero. So if your parents own stock that they've owned for 50 years and you have no clue what they paid for it, they deem that basis to be zero. So you could inherit $5 million worth of stock, pay estate tax on 1.5 of it, and then have to pay $5 million worth of capital gains on $5 million.
Wow. So let me ask a question. I apologize for interrupting you, Stephen. So this would be advice for our clients, is make sure you're communicating with your parents about everything, right? They need to document this stuff because, people pass away sometimes unexpectedly, and then your children are left, which we've had clients like this, left with so many unanswered questions. And if the laws are changing in this degree, people really need to prepare. And then tell us about, Stephen, which a lot of our clients are going to have questions about, is the real estate step up in basis. So explain what the law currently says, and then explain what you've heard it's potentially going to change too, because this is a big preparation for our clients as well.
Right. So what it right now is when somebody passes away, you get a full step up basis to the fair market value at the date of death. And so that's fantastic. It makes it really easy. So you can sell an asset, have no gain. It's really a kind of clean slate. It makes a lot of things easier to do. Under the Biden plan, that might be under the chopping block, where you would have the basis of what your parents had paid for that house. So if they bought, we'll use an example of my grandparents. They moved to Danville and bought a house for $38,500. They sold it for $1 million. But it was after their death, so we got a full step up in basis. But under the new plan, you may not get that, and you'd have to pay the full gain from the $38,500 all the way up to $1 million.
So this is such a great point, because again, this is real estate related questions that our clients have. We have families that we've worked with for 25 years, and they over the years have worked very hard to purchase investment properties. And their plan at some point, as far as helping their grandchildren and future generations build wealth, that they're going to wait to do something with this property until they pass, and then they give it to their children, who then can take a step up in base, which just means that they take the taxes based on the current value rather than what so they can take it without having to owe a bunch of money on it. If they sell it, they don't owe a bunch of tax. So if that's the case, and this would be a good strategy for our clients right now to start thinking about how they would prepare for that, right?
Yeah. So there's two things you really want to look at is, because you do have if this comes into pass, and we don't know exactly how it come to pass. I think there's going to be a lot of unhappy people with no step up in basis. There's going to be a lot of people who challenge it because it's going to be an administrative nightmare for families who just are dealing with the passing of a loved one. But it also brings up primary residence. You do have the investment property situation, but primary residence, you still have the primary residence exclusion, which is $250 per person, so you get $500 exclusion there. The other thing you also want to look at is, you have that real estate, but if you have total other assets, you have more than you need to live on, you may want to start gifting those to your children. You need to talk with an attorney to make sure that you may want to max out, because under our understanding that even if you gifted out $11 million under the current plan, that money would still be exempt if the plan changes. It wouldn't be retroactive.
Okay.
So, you know,
Yeah, the clawback.
what?
Yeah, there shouldn't be a clawback, right?
Yeah, there shouldn't be a clawback. And so, you know, you might want to work with your CPA and your attorney to look at what assets can we get out of our estate so our estate is lower, and move it to the next generation so that it starts building wealth there, which, you know, it may just push the tax bill down the line a little ways, but with a 3.5 per person, 7 for a married couple, it may not, you may want to just give everything away down to $7 million. And so you're not.
What's the amount per year that someone can gift without paying tax per person? I know that it's changed recently, right?
So
15.
Yeah, the gift is 15. So you do not pay tax though until you exceed the lifetime exclusion, which is 11.5 million right now.
Okay.
And the possible 3.5 under the Biden administration. So you could give away $10.5 million or $11.5 million, not pay any taxes. You do have to file a disclosure, 709, gift tax return, but there's no taxes due until you exceed the lifetime exclusion.
Okay. Well, that makes sense. So thank you so much for that. So I know that Diana, you had a client that had a question. Fire away.
Yeah, so this question is for Steve too, and I think he answered it a little bit, but Mary from Pleasant Hill, she wants to know if it is a Biden administration, you know, based on what you heard, what are some potential tax changes that we might see?
So I think you'll see a lot of little changes here and there. Biden is projected to say that the taxes for people under 200 single and 400 married filing joint shouldn't change or should stay the same or go down. But what we'll see is the higher tax rates increase from projected of 37% to a 39.6%. People who have taxable income over $1 million, capital gains rates will go away and they'll be taxed at ordinary income. There could be some changes. Well, I know there's another couple questions coming, so I don't want to go into all those details, but overall, I think if you're under 400, I think your tax bill is going to be about the same. It's going to watch out with changes where some things will increase and some things will decrease, but it's going to kind of looks like it's going to be the same for under 400K.
I have a question. Is that under 400 for a single person?
No, it's 200 single, 400 married. They haven't exactly labeled that, but they say 200, 400. But that, I mean, it's all going to change. So you look at kind of ballpark of what they're looking at there.
Yeah. And then I have a question for Martin. So Martin, and you specialize in helping people relocate with a strategy. So most of our clients, or at least a lot of them, are retiring, moving out of California, just making a change in the state that they live. Knowing that that's the case, what advice would you give someone to prepare if tax changes are coming down the pike that may not impact for another year? What would you say that the best advice for them to help to get them prepared?
Well, yeah, thank you, Lisa. This comes up a lot. I've had a lot of conversations with clients that have relocated in the past or thinking about it right now. And
yeah.
And as you talk about, I mean, we have all this spending for COVID, the stimulus, all the states are in budget deficit territory. So most everybody you talk to, says that taxes are probably going to be going up in the future, and especially here in California. And a lot of people are looking to relocate out of California, not just tax reduction, but also for quality of life stuff. So when we do advice, quality of life issues are important. Access to healthcare in a new community, access to a major airport so they can get back here to visit family and grandchildren, that sort of thing. Access to cultural activities, all those are kind of important. And the first thing we kind of look to is some of the national rankings of the best places to live, best places to retire. and then kind of customize our recommendation based on the individual and based on all those factors we just talked about. But more importantly, then we do some, in-depth cash flow modeling to show, how we can deploy their retirement assets, taking into consideration that we could, access things like stock options and, retirement plan distributions. And, we time that so that, those tax events are incurred in a lower tax environment.
Right.
As an example. We also looked along the line of the work that you do, Lisa, look into, downsizing and being able to access, appreciation home equity in their home and, take some money out of their home and put it into the retirement income, use that for retirement income and model that. So there's a lot of moving parts, but we can certainly weigh in on all those decisions and help people get their arms around what the best, does it make sense to move? Does it make sense to stay? And what's the cash flow going to be if they stay? What's the cash flow going to be if they lose, if we move the pieces around? So
Exactly.
It's a little bit of a puzzle, but we can put it together.
Well, that's awesome. And we also want to share, I don't think we talked about this yet since we went live, is we believe that paying taxes is our rent to live in a beautiful country like we do. We all want to pay our fair share. We just want to learn how to not pay more than our fair share. That's why we have great people like Stephen and Martin to help us make sure that we prepare and plan, and also help our kids, prepare and plan. I had a question for you. Both of you can answer this real quick, and then I know we have other clients that have asked questions. We'll jump in. So we've heard if it is a Biden administration, we have heard that there are things that could be on the chopping block. Like, for instance, we work with a lot of investor clients. And so the 1031 exchange is a tool that many clients use to postpone or change the taxes that they would pay on an investment property. Have you guys heard what we've heard is that might be being removed, or do you think that that's just something that we've heard that's not true?
Every year.
Yeah, Lisa, go ahead. Go ahead, Stephen.
You go ahead first time this time.
Go ahead, Martin.
Okay, yeah, I was going to say our firm, we've done some briefings on analysis of the Biden tax proposal and elimination of the 1031 exchange above 400,000 income is definitely in his proposal, among other things like eliminating capital gains treatment over 400,000 as well. So and there's also the donut hole for Social Security taxation over 400,000 as well. So 400,000 of joint income tends to be the real critical number,
okay.
And that just lends itself to thinking about controlling your income and controlling your income and also controlling the taxable events that you may have, like selling a piece of real estate or tapping into long-term capital gain investments and things like that. So controlling your income so that it falls under that 400,000, in the critical year that you make those decisions is, can be really important. And one of the tools in the toolbox is charitable planning, charitable gifting planning, and, getting an off deduction to bring your income under that threshold, and also finding additional retirement, especially if you're a business owner, finding some additional retirement plan contributions to reduce your taxable income and try to play a tax arbitrage where you incur the tax in the year that, is the best timing to incur it. So those are some of the things that we look at.
Well, and one question that I've had from a lot of past clients when they're talking about capital gain taxes on investments, is it dependent on their income, what they pay in cap gain, or is it straight across the board? It's a fit number. And I should know the answer to that question, but I want to make sure I get it directly from you guys. So Stephen, what is the capital gain tax for investors?
So capital gains right now under current law does vary depending on what your income level is, anywhere from 0 to 20%. And when you hit the 20%, you have the net investment tax or the Medicare tax of 3.8% that kicks in. So it is varied on that. And under the Biden plan, it kind of alluded to, it varies also a little bit. And then at some income level, I've seen 400 and I've also seen $1 million where it just goes to ordinary income of 39.6%. So we'll have to see what it changes to. But right now it is determined by what your other source income is. And then under Biden, anywhere from $400 to $1 million married, filing, joint. it could go up to ordinary income rates.
Wow. So TJ, you had a client who asked a really important question in our industry. Fire away. Let's see how we can help them.
Right. Yeah. So there's, questions about what is it going to look like for a first-time home buyer under, potential new administration. What can they expect as far as the first-time home buyer goes?
So the question is, what can we expect for
Can you guys hear me?
under the new administration?
First-time home buyers. Yep.
So there's alluding to increase first-time home buyers and to get people into the market is a $15,000 tax credit. They kind of did that back in 08 and 09. They had a tax credit. In 08, I think it was $7,500 was actually in advance, and then you had to pay it back over time. And then in 09, it was an $8,000 actual credit that did not need to be paid back. And so it looks like they're looking at doing that again for a $15,000 first-time homebuyer credit. I would not be surprised if that credit has some limitations to it. By income too, it seems to be the theme of all the tax plan is that under 400 you get a lot of benefits. Over 400 they go away. So you could probably see that there's going to be something, whether it gets to 15,000 and income levels change. But yeah, it looks like there could possibly be a good credit for home buyers.
I have a question too.
Go ahead, Sasha.
In regards to that. So, and so let's say, like their first home buyer bought this year, would they be able to take that tax credit, or is it only going to start 2021 or, whenever it could start?
So that, it was brought up, we don't, it looks like Biden's going to win, but really a lot of these plans, tax policy really comes from Congress. And so the administration can really push for a lot of things, but depending on how Congress reacts is to what we get and how fast things can be put through. So in saying that, I'd be surprised if obviously either way, nothing happens until next year. But 2021 would probably be when all these policies would start appearing. And so I think, or 2022, sorry, 2021 would be very similar or exactly the same as where we're at. Maybe some extra things that are retroactive that are beneficial. But I think a lot of these will be more 2022 type situations than 2021.
Yeah.
Hey, Martin, you had mentioned before when you were speaking about the timelines and planning for someone who hasn't used a wealth management service or provider like yourself. How do you plan, and when should they take into account if they're moving to, say, Colorado or Arizona? When should they contact you, or as far as the timeline goes?
Well, earlier the better. Obviously, we want to, if we can time things like exercise of their stock options and things like that from work. We'd like to have some, or a sale of a business, or tapping into qualified retirement plans. If we have some head start on that, we can kind of time those critical tax events, when they are officially relocated and established residents in a place like Washington or Nevada, or Texas or Florida, where that has no state income tax. So, the earlier the better, and we can make if we get in early, we can start to plan in terms of what, if they are going to stay in California, how much longer do they have to work, how much more do they have to contribute into their investments and portfolio to make that happen. Or if we're going to retire in another state with lower cash flow expense needs, when can we execute that? When can that happen? So, the earlier the better, obviously, so we can plan for that. What you don't want to do is wait too long and make a move to a place like Nevada, and then tap into everything, and then have an issue, as we talked about before, with the franchise tax board wanting to, claim that they still have a claim against some of that income because you weren't officially relocated and established resident somewhere else, that you still had some lingering attachment to California, and they had, some claim to that.
So, and provide with that in mind, I have a client who asked me recently, Martin, and Stephen, you could both probably answer this question. So let's say, people are allowed to have two homes, right? They might own a house in Lake Tahoe, the Nevada side, and own a house in Danville, for instance, and they spend time both places. Do they have to become a permanent resident of Nevada and then own this California as a second home, or how would they structure that so that they can take advantage of the fact that Nevada doesn't have a state tax?
Well, I'll let Steve talk to that, but I think we talked earlier about how you really have to make a break and how aggressive the franchise tax board is in terms of tax collection. I'm sure Steve has seen a lot of this firsthand, so I'll defer to Steve on this.
Exactly.
Yeah, Martin, you're exactly right. California basically says if you look at a map and read the name California, you're a California resident. They want your money, and they have uses for it. So if you want to do and they're very keen on looking at people who live in Lake Tahoe, Nevada side. So if you're pulling that, you really need to make sure that you have a separation. Make sure that all your bills go to Nevada. You have a Nevada driver's license. Your cars are registered in Nevada. Your doctors are in Nevada. Because if you still have a residence in California, you need to make sure that your primary residence on your tax return and anything you file is all Nevada.
Okay.
Have your California property taxes mailed to your Nevada property. Because if they think that your connection is still more than 50%, they're going to say that you're a California resident and you haven't broken ties and you still owe California taxes. So you really need to, especially if you're living in like Tahoe, it's easier if you move farther away, and really make sure you're there more than half the year.
Okay.
They will pull phone records. They will pull your doctor records.
Wow.
Because phone records, if they really are going after you, they'll see where what cell towers your phone goes off of. And if it goes off of the California towers more than the Nevada towers, you're a California resident.
Wow. That's crazy.
Yeah, I've heard that. I've heard they will subpoena cell phone records and credit card records and find out where you're spending your time and your money. And yeah, exactly.
Wow. That's so interesting because I can't even tell you how many clients that at least I know personally that own a property in Nevada. They own a home here. They spend time back and forth because their children are still here. And I have never had that conversation with them. So thank you for sharing that. That's so very valuable. So who else has any questions that we want to ask? I know you guys are such a, what a wonderful resource of information the two of you are.
So I have a question from a Matt here in Danville. Under the potentially new administration, how are the itemized deductions likely to change?
So we haven't gotten all the details, but right now the taxes, your mortgage interest is limited by the size of the mortgage, and your property taxes and income taxes are limited to $10,000. Charities are limited to 50% of your taxable income. Now, under the new plan or the projected plans by the Biden administration, what they are looking at is not necessarily limiting individual itemized deductions, but limiting them as a group in a whole to 25% of taxable income. And so that could change a little bit on how they administer that, depending on what they want to influence to be better, home buying or property taxes or anything like that. But it looks like what they'll do is they'll cap your itemized deductions to 28% of your taxable income.
What are they now, Stephen?
So right now, there's not necessarily a limitation on the total dollar amount. They're limited, so medical, you can have unlimited as long as it's over 7.5% of your adjusted gross income. Property tax and state can't be more than 10 grand combined for federal. And then mortgage interest, your deduction is limited by the size of your mortgage. If you have a mortgage before 2017, it's $1 million. If it's after, it's $750,000 of home indebtedness. So, and the charities at 50% of AGI. So each category under the itemized deductions have limits or barriers that they have to meet but once you get to the total, you get it all, with some slight limitation. Where under Biden, it looks like what they'll do is they'll let you have it all, and then when you get to the total, they'll give you a haircut of 28%, not let you have more than that.
Now, is this the same for your corporation tax deductions? Like, for instance, you run a business, are they capping the deductions on the business as well, or is that just personal income?
That's personal itemized deductions. So deductions on the business level, I think right now, overall, the deductions would be very similar. We don't know how they're coming out for entertainment meals. I don't see those coming back because I don't think the IRS really likes those. But your regular, normal, standard operational deductions for a business, I think they'll stay very similar.
Okay.
One of the things that for self-employed people that I have not seen directly, and Martin maybe sees, is how they're going to react to QBI, or qualified business income deduction, which is the 20% deduction towards taxable income for businesses, or for individuals with, that are sole proprietors who own S corps or partnerships, or even commercial rentals in some situations. I haven't seen it directly, but I wouldn't be surprised if that goes away, or has limitations on income imposed more than they are.
Yeah, Steve, I did hear that was one of the ones that was going to be eliminated at $400,000 of income as well as the other one we talked about. So, yeah, I heard that's going to be in jeopardy as well.
Yeah, it's pretty hard because, there are states across our country, California being one, probably New York, maybe Chicago, areas where the cost of living here is so high, like Felicia was alluding to that earlier. A lot of people are above that range of income because it does cost a lot to live here. So, the change could impact California residents quite a bit. So just, planning is super critical. And then Martin, I have one last question, and then I wanted you two to kind of just jump in with any additional information that you think that consumers are always asking you. Is Martin, with knowing that the itemized deductions will change the way that we perceive that they will, is there any strategy that you would give them advice as far as when they're doing their wealth planning? Is there anything that we could start to change that will allow us to, other than what you've already shared, to eliminate or reduce our required taxes?
I think timing and control of your income, so that when you do have tax events, you can potentially get below income limit and, still have the ability to work, with some of the tools that we have. But in general, we're moving, most people think we're moving into we're going to be in a low interest rate environment for the foreseeable future. Income inflation is going to potentially be higher because governments tend to print money to pay off debts and deficits. So that, that lends itself to higher inflation in the future, higher taxes in the future, and higher volatility in the market. So, in terms of, when we put together our retirement plans, our wealth management plans, looking at things, traditionally we've looked to bonds, as a safety and stability in one's portfolio, to generate income for retirement. And, in such a low interest rate environment, that has not been the foundation. That type of foundation is maybe not as viable anymore. So we're looking to things like real estate investment trusts, alternative investments that can generate income that are not dependent on interest rates or bond yields, have become much more part of the conversation. Hedging investments, putting hedges on in terms of volatility control, and also looking into tax advantaged investments, looking to things like maybe do a Roth conversion and take advantage of the Roth if you're qualified for Roth conversion, or maybe using life insurance as an investment alternative because of all the tax benefits of life insurance as an example. So, those are things that, traditionally we haven't talked about, but we're starting to talk about more because of the unique environment that we're in now. It's going to take some more creative thinking going forward, not only with the income tax and with the investment landscape and the economic landscape, but also the estate tax on the end of life, things that we can do. There's a lot of strategies that we can do to make sure that you leave that legacy to the next generation and not get nailed with the estate tax as well. So there's a lot of things that need to be addressed that in this new environment that we're facing that take on a great deal more of importance right now.
For sure. Yeah, I mean, I would recommend that anyone watching and anyone who sees this, this information will be available moving forward for all of our clients. And if you guys have questions, that you weren't able to pose for today, Martin and Stephen, we'll make sure that we give all of our clients and the consumers your contact information, because I would highly recommend meet with Stephen and meet with Martin and, do your estate plan, do your tax plan. Think about, even if you're young and you're just starting out, it's time to start thinking about your future so that you can prepare. You want to be able to build investment and build wealth and build a strategy where you don't spend the first 10 years of your working life making mistakes. Martin and Stephen can help us prepare, And I had one last thing that I wanted you to clarify, Stephen. You talked about a tax credit for first-time home buyers. A lot of people don't really understand what that means. So like a first-time buyer that might be watching this video or playback, they want to buy a home. What exactly is it when they get a tax credit? I just wanted you to explain that.
So tax credits are awesome because it's really a dollar for dollar money coming to you. So, we usually talk about deductions, and that just reduces your taxable income, which will be forced against tax rates to produce your tax due. Well, this will offset the taxes you have due dollar for dollar. So $15,000 would be $15,000 in your pocket. I've read both refundable and non-refundable. What that means is that if your tax liability is over $15,000, then you get all of $15,000. If it's less, then you don't. But I think that if they do this, it will probably be a $15,000 refundable tax credit, which means there'll be $15,000 basically listed on your tax return and coming straight to your pocket.
Yeah, that's awesome.
So it could be a really beneficial. $15,000 doesn't go as far in California as it does in a lot of other states.
Yeah.
$15,000 is a fantastic opportunity.
Well, it's wonderful because we think about, and especially in our area in California, a lot of young families, they may have very good incomes, but because the cost of living is so expensive, saving money is difficult, right? Saving money for your down payment, saving money. So a tax credit means that you buy a home and then that year, like you said, it's $15,000 in your pocket that you normally just pay to the government because you don't have a home to write off and you don't have all these things. So it's a huge benefit, an extra incentive.
It'll be a great opportunity for people who are first home buyers. One of the things that you have here is you have the supplemental tax bill that comes in addition to your regular increase. And most people don't plan for that. So this will be a great credit to help pay that and to take that surprise away.
Yeah, exactly. Gosh, you guys, thank you so much for working with us today. This is such a great, a contribution to our clients. Is there anything else that you two would like to share? Just like any other little tidbit that we didn't talk about?
I do want to reiterate something that Martin and both you, Lisa, have said is that because the tax plan won't happen for 2020 and probably not for 2021, is that you may want to look at the situation. If you're in the higher income level or your higher estate levels, to talk with your attorney and CPA, because you may want to accelerate whether you're doing gifting to your kids or other people, or whether you have, if you're planning on selling a vacation or a rental in 2 or 3 years, you may want to do it this year or next year to realize those gains at a lower tax rate. Because I agree, as Martin said, is that we got to pay for all these packages that we're doing because of COVID. So tax rates for people who have higher income in California and in federal are going to probably go up. So if you can pull money and take advantage of these lower tax rates, you might as well do it.
Yeah, exactly. Thank you so much. And Martin, I have one more question to ask you guys, but I want to have Martin share. Is there any other tidbit that you would share that would be helpful?
I would just echo what Steve said. It's important to the thinking and the planning that we've done in the past, we're going into a new administration, a new world. We have COVID that we're dealing with, and a much different economy. And the planning that we've done in the past it's not necessarily going to work in the future, and it's going to require new creative thinking. So it's important to sit down and maybe take a look at your options now.
For sure. So one question popped into my mind, that if indeed the step up in basis is something that goes away, I've had clients who have already done this, and I don't know if it would actually work, or if this is just something that will get them an audit. So people sometimes will say, okay, so my son and daughter-in-law, whatever, I want to just add them to title. That means that they become owners of this property. So now there's 4 owners instead of just 2 owners. How long do they have to be an owner before you die, where they would then be able to just capture the home as something that they own, instead of the inheritance taxes and all that?
Well, so if you gifted part of the home, that would go under your lifetime exclusion. So you could gift the home. That really is hedging your bet, saying that the step up's going to go away and always go away.
Right.
So it is hedging your bet on that. So you really need to examine your situation. But if you did decide to gift your home, because you're also then, when you're gifting your home, you're gifting away part of your opportunity for a primary residence exclusion at the $2 each, or $500 primarily filing joint. So you really want to look at your situation and say, hey, is that good to gift it down? And when you gift something, you gift it with your basis anyway. So in both those situations, the basis of the children would be the same as the parents.
Okay.
So the only thing that gifting would really kind of look for is that if they sold it to the kids, then they could exclude $500,000 of the gain. And then the kids could then move in there and exclude for 2 years and exclude $500,000 of the gain. So that would be the step situation where you'd want to say, hey, my kids are going to want this, and so we sell it to them. But that would kind of say the parents are either moving out. They could hold the note so that there's really not much transfer of money, but you really want to evaluate the situation, the facts and circumstances. It's not going to be right for everybody, but especially a home that somebody who wants to have for the next generation, gifting it maybe early or selling it early with a holdback note for the parents, which would provide income for the parents. And there's some real opportunities to do that. And I've seen similar things like that done. And that should, under current circumstances, keep the property tax basis also for the next generation, because it's a parent-child transaction.
Yeah, exactly. Yeah, no, thank you so much, you guys, for your contributions today. I know everyone's going to gain so much from the information. And of course, we'll share your personal contact so that when they do have their plan, which this is one of the reasons why we wanted to share this information at this time of year, because this is when people are planning for next year. And then, of course, knowing that we could see some major changes depending on administration, we wanted to share that as well. So thank you guys so much. Anybody else on the team have a question or anything we want to run out, give to them before we let them go?
No, you guys are very helpful. Thank you.
Oh, great. Thank you.
Thank you, guys. You're awesome.
Yeah.
Thank you, Lisa.
Have a good day. Thank you. See you soon. Stay well.